The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. My name is Bobby Rains. This is our once every 3 weeks members-only workshop for Investors Observer. Let's get started. All right, so this is our agenda for today. We're going to look at some charts, talk about what else is happening in the market, talk about what sectors and industries are doing particularly well recently, and then the rest is up to you. For the first time in quite a while, I had no questions submitted ahead of time, so there'll be plenty of time to go over whatever it is those of you who are hearing my voice right now want to talk about. You can put questions in now. You can put them in if something comes up while I'm talking. You can save them to the end. Whatever. As always, if you want to send questions in ahead of time, just send a question and say, hey, talk about this in the workshop. Or what a lot of people do is when they get that workshop invitation, they reply to it and just say, hey, here's a question. All right, so with all that out of the way, let us look at some charts. Okay, this is 1 year on the S&P 500. The last time we talked was, I believe, the day of this big red bar. So things are looking decidedly better since then. There's a few things going on here in terms of this doji candle sort of being at the bottom. A doji is a candle that has no body. It's where the open and closures are basically the same, but there's a long wick on either side. That a lot of times can be a sign of a reversal. And then, yeah, you see we hit this level here and then hit it again and then have been up since then. So it's not necessarily guaranteed that we won't go lower from here, but it does seem, I don't feel too bad about this. Certainly, and I think some sort of consolidation here. These were pretty big up moves, and then you get some consolidation. That's also sort of not surprising. So yeah, where we are is sort of, we've been above 4,000 for a while. I'd like to see us get back above whatever this level here is, and then take out like 42, and then I'll feel pretty good until there's some resistance here at 43. We can see where these things have topped out. But once we get back to there, it should be, depending on what's in the news, it could be relatively smooth sailing back up to, somewhere even higher than that. All right, so the NASDAQ is different in this. Oh, sorry. This is 3 years of weekly candles on the NASDAQ. The NASDAQ is just down more, and so we got into some older stuff here. This real long line. The length of the line will show you when it was I put it on the chart. So this real long line shows some resistance that the market hit going up in the fall of 2020. And then it served as support here, and then we're back above that line now. We hit a nice, again, right, a similar pattern. We'll look at it on the daily chart in a minute here, and we've come up and then consolidated. If we go to the daily, this looks pretty similar. We don't have the nice doji like we did on the S&P, but you do have sort of two cracks at this level and then a jump and some consolidation. Like I said, it has come down a little bit further. I think sort of this area in here around 1,300, 13,000 will be big. Once we get through that, I think it should be a little bit easier to go back up. We'll talk about tech as an investment a little bit more a little bit later, but yeah, the charts look similar. The Russell looks different. It only really hit this bottom level once, and has sort of kept sneaking higher during the period while the other indices have been consolidating, which is kind of interesting. Small caps sometimes can be a sort of bellwether or a leading indicator, but sometimes they're not. But it is interesting to me that the Russell seems relatively stronger in the last couple of days than the other two, because it has not been that way for quite a bit of the last couple of years. All right, the S&P 500 versus the equal weight. This is 180 days. The regular cap weighted S&P is in blue. The equal weight is in the multicolored candles. And you can see they track relatively closely, but we had, some divergence really open up around the first of the year, which incidentally is when the S&P 500 peaked. And it's been down since then. And really what this is showing is that the big tech companies at the top of the S&P 500, your Apple, Tesla, Google, Microsoft, Amazon, have all underperformed sort of the other 490 whatever stocks in the S&P 500. Okay. Growth versus value. Again, this is also, I think, 180 days. You can see again the divergence, right, really happens right at the first of the year. I don't know. Yeah, I don't think there was anything magical that happened when the clock went from 2021 to 2022, but that was definitely when something really changed in the market as far as that goes. But you can see even here on a relative basis, value has outperformed, but the gap is sort of closed over the last couple of weeks in terms of how far away the lines are. It hasn't closed much, but it has gotten a little bit tighter. And if this was a 5-year chart, the growth would still be significantly higher than the value stocks. But we want to talk about what's happening now, so we look at a shorter window. All right, so what else is going on? Interest rates, inflation, the Federal Reserve is still largely what's driving the action. It's kind of back in the driver's seat after the pandemic and the war in Ukraine and some things like that. We're sort of moving the market for a while. So tighter money typically just means higher financing costs, which means higher yields on interest-paying things, and typically lower earnings multiples on stocks. The CPI at the end of this week is going to be very interesting. Generally, I think the consensus is for things to cool off a little bit from last month. So that will sort of be the expectation. But really what will be interesting will be the market's reaction in the sense of if inflation is significantly less than expected, will that spark a little bit of a rally? Will a higher than expected number bring out the bears, or will we get a sort of weird good news is bad news kind of thing, where lower than expected number could also be met with some selling? Because the news is important, but for investors, right, like what actually matters is what happens to stock prices. So that'll be an interesting thing I'm keeping an eye on, just because I like to know how the market is reacting to things. For a while there, it seemed like every piece of news the market just reacted negatively to. We seem to have gotten out of that a little bit here recently, so I'd like to see that trend continue. But also there has just generally, right, we just looked at that growth versus value chart. There has been a little bit of a sort of regime change in the market. Cash generating businesses are attractive again. Tighter financial conditions and growth in the real economy means that speculative bets become less attractive. We talked several times during the sort of pandemic era about how if there was no big outlook for economic growth, then what you needed to look for were companies that could change the paradigm, right? Tesla is an example of this in the sense of it's not a particularly large company, but it has the potential to sort of change and reshape an industry. Whereas, General Motors or Toyota could sell nominally more cars, but the opportunities for growth are significantly less. And so what happens when the economy slows down and there's a lot of money in the system is money flows into those more speculative bets. just because there's less opportunities for the big established, especially sort of brick and mortar or physical goods companies to grow. Whereas some company that could really change something has a lot more potential for returns. And so what we're seeing now is a little bit of unwinding of that, in the sense that, like, Coca-Cola, GM was maybe a bad example there, but Coca-Cola and Philip Morris and some of those other more more established companies that have less growth potential, right? Like the chances of Philip Morris being significantly larger 5 or 10 years in the future than it is today aren't super big, but it throws off cash right now, and so it ends up being a safer investment, and it's not just money sitting somewhere not earning anything, where again, right, like people are pulling out of some of the more speculative stuff. All right. There's a lot of retail earnings stuff over the last couple of weeks. Also, Target. I think Target has cut their outlook twice in the last 3 weeks. Walmart's numbers weren't great. There's some other things that were kind of interesting. But if you dig into those reports a little bit past just the sort of headline numbers, the causes for those are a lot about supply chains and the speed and changes in consumer behavior. Target, for one, just got a lot of stuff late. So they sort of, received a bunch of stuff they had ordered. We all know how snarled shipping was for a long time there. They just got a bunch of stuff late, right? So they got spring stuff in June, or they got Christmas stuff in May, and there's not a lot of demand for it. So what's interesting is it's certainly not great for those companies, especially because they have to either pay to store that stuff and keep it out of the way, or try to sell it at a discount right now, which seems to be what Target and I think some other companies have said they're going to do. So that big sales on things, it turns out, are pretty helpful when you're worried about inflation, because what is a sale but lower prices? So I don't take those retail earnings as a sign of sort of weakness in consumer spending. Consumer spending generally seems to be holding up pretty well. But it seems to be an issue for those particular companies in general. And Target is kind of a weird one also, because it's very sort of in the middle of the market. If you look at like a Nordstrom or a Macy's, both of those did okay. Walmart has done relatively better. A lot of times in sort of uncertain economic times, you get a little bit of a barbell shape in retail in terms of who does well. Rich people just worry less about recessions, and so spending at the high end stays relatively constant. And on the low end, right, people are selling a lot of necessities. So the sort of difference between Walmart and Target becomes sort of bigger in terms of how, at least how the stocks perform, if not how the companies perform during that kind of economy. All right, so the stuff that's hot right now, before we go through these, let me show you where they come from. The sector and industry page is here, and what I like to do for this particular piece of the presentation is look at the short-term technical score. So this looks at the last couple weeks to 2 months, and considers what industries or what companies have the strongest what companies have performed the strongest over that sort of time frame. And you can click into any given sector to see both the companies that are doing the best and also the industries that are a subset of that that sector over here. So yeah. All right, so what are they? Energy remains at the top. I don't think that changed, or the units in there. Thermal coal, I feel like I say this every time, but thermal coal is kind of weird because it's relatively small. industry at this point. It's oil and gas drilling aren't what they used to be, but thermal coal has gotten decidedly smaller. Utilities, again, those two are, I think, the only two sectors that are actually up for 2022. And the story there is pretty obvious, right? Like, I think we all know oil prices have gone up. High oil prices leads to additional demand for some other things, natural gas and coal among them. Utilities is a lot of it's a safety play. A lot of it is the thing I was just talking about in terms of businesses that throw off cash, right? Utilities tend to pay a dividend. They're relatively less volatile. There's not a ton going on there. Not a ton of growth opportunity in the utility sector either, but it is cash in your pocket on a pretty regular basis from those dividends. Basic materials went from not in the top 5 to 3rd on the list. It bumped, I think financial services was near the bottom last time and it bumped it off. But yeah, this is again, right, a little bit about some supply chain stuff, a little bit about some energy shortage stuff in terms of lumber and wood products. A lot of that is supply chains and housing prices. Even as housing prices have started to cool a little bit with higher interest rates, people are still, building houses, and there's some tightness in the lumber market. Coking coal is the coal that's used in the steel making process, and agricultural inputs is fertilizer and pesticides and some things like that. So it's I think pretty easy to understand what's going on there in terms of the shortages in food caused by largely the war in Ukraine and also some weather issues around the world. Real estate, not a lot of change there. Residential is obviously residential. People need places to live. Specialty and industrial REITs, a lot of that is warehousing or other stuff in the logistics chain. But it also, REITs tend to pay big dividends, so it's not surprised they would be strong in light of the sort of regime change I was talking about a little bit earlier. And then industrials, we're back to, this is again a story about both of the sort of themes for the last couple months and also this presentation in terms of that regime change narrative, right? Like marine shipping is not an industry that grows particularly fast. Neither is infrastructure operations, which is like companies that operate seaports or airports, or, if you had like somebody operating a railroad or some other freight hub or a railroad terminal or some other freight hub that wasn't necessarily the actual railroad company, that would be infrastructure operations. And then trucking obviously is trucking. None of these are industries that grow particularly quickly, right? They're not, nobody's talking about being disruptive. There's not a new technology story or anything like that there, but they are companies that are in demand and companies that are generally profitable, and when things are going well in particular, can throw off some cash. All right, that's a question left over from last time. I just forgot to delete the slide. All right, so questions. We are to the end of my prepared slides, so the rest is up to all of you listening. All right, so Vic asked if there was a way to view all stocks by the percent of price change live each day. We don't currently have that available. We're working on a bunch of pretty major upgrades to stuff that you should start seeing roll out hopefully in the next couple of months. That is near the top of the list. I don't have a timetable on any of those things, but that is absolutely a thing that we are working on. All right, so Sheila says, how do you feel about electric charging stations? Electric charging stations is interesting. It's certainly a thing that seems likely to grow as more and more electric cars get sold. There's a lot of things I don't necessarily understand about the industry in terms of currently it seems like there's a lot of providers that are co-locating at fuel stations or doing some other thing like that. And yeah, I kind of expect there's nothing proprietary about electric charging stations either, right? Like having a not proprietary charging station, I think is probably more attractive. So at a certain point, somebody will probably buy up the larger companies and the other ones will fall by the wayside, and they'll be, you look at something like here on the East Coast, we have Sheetz and Wawa. I know there are some other companies, but these are big convenience store operators that aren't in the, right. An Exxon station, obviously, it's run by an oil company. But the big convenience store operators that operate, sell a lot of fuel, but also run a store, I expect those will probably get into electric charging business at some point. So I do see it as a growth industry. I think some of those things are a little bit overpriced because of all the regime change stuff I just talked about. That was one of those things that was super hot during the pandemic era. And I'm not sure we're to a point yet where there is a real value play, but it's also a thing that I haven't done a lot of research about. All right, so Craig asks, what does risk on, risk off mean? Just the thing you hear people say a lot. It's really a thing that has to do, it's much more relevant to people who are short-term traders or just trying to describe what's happening in a particular market today. And risk on means essentially people are buying or money is moving into riskier assets, which would be traditionally it would be out of bonds and into stocks. More recently, you'll also see cryptocurrencies going up and things like that. But really, it just means it's kind of a way to describe the weather in the market, if you will, in any given day in terms of are stocks going up? Are people looking for sort of safety assets, which is generally sort of short-term treasuries, things like that. So Chris asked, what do you recommend for sitting in cash? Yeah, that's a tricky one just because cash means different things to different people. Right? I mean, you may have a checking account, which is obviously cash, and a savings account, which is obviously cash. But then there are other, money markets or, some sort of short-term bond fund or something like that. All of those things might be cash, but it really depends on, and yeah, those are all relatively close to cash. But yeah, I mean, at that point, typically what people are looking for from a cash position is a lot of stability and not a lot of return. Where people get into trouble is thinking that something is the safe as cash, but trying to chase yield at the same time. Right. So typically things that have a high yield are not as safe as cash. And so that's where people tend to blow up or get in trouble is thinking they can get more get more return off of their cash than what really is available. And so you trick yourself into thinking that something is the same as cash when it's not really cash. So PK asks, how long do you expect the energy sector to keep moving higher, and your reasoning? I mean, right now it seems like it's a little bit of a sentiment play. There's some limit to how high oil prices can go without getting a lot of demand destruction, which should, if you destroy a lot of demand and keep the supply the same, right, like that should ease up prices and sort of loosen the market a little bit there. I don't really know how long I expect that to last. There's a lot of things that could happen there in terms of largely relating to Russia and Ukraine. Most of the other countries that produce oil seem to be pretty happy with the high prices and are relatively disinclined from the expensive capital investment of increasing production, which would also take a while. And the onshore producers in the U.S. seem to be in a similar boat where they are much more interested in making money and returning cash to shareholders than a lot of expensive capital investment there either. So I don't know how long I expect it to keep going up, but I don't see any signs that the market is getting oversupplied with oil, and we're going to see something like we saw in 2014, where oil prices and a bunch of oil companies all sort of fell off a cliff. China, I suppose, is another tricky one there, although as long as China is buying a lot of Russian oil, I don't know that their economic activity has a huge effect on the rest of the world's supply of oil. Do you think we're in a bear market rally right now? And if so, how long do you think the S&P will get? How low do you think the S&P will get this year? This is the kind of thing that I don't know. We talked about during charts and some of that stuff that there's some reasons to feel pretty good about where we are right now. Stocks typically go up over time. So I'm not as pessimistic as I was several weeks ago. It helps that stocks are up from where they were several weeks ago. But I mean, there are some things that are certainly still overvalued, probably. There's some things that are starting to look attractive. I think, there's another question down here about the valuation historically. But yeah, I don't have a year-end S&P 500 price target. I just don't. I do some things that are relatively short term, and then I have some things that are, retirement accounts that are pretty long term. And so weird, like 12-month targets don't have a lot of bearing on anything that I care about. But yeah, I mean, stocks can keep going down until people decide they don't want to sell them anymore. But I feel like sentiment has definitely improved from where it was a couple of weeks ago. There's still some stuff I see where I'm like, this is crazy and seems like it's, priced too high. But things are certainly less crazy than they were at the beginning of the year. James says it's too early to get into lithium stocks. I don't know. I think it depends on the stock. Something like Albemarle is a big company that's been around for a long time, and they're in the lithium game. Some of the other ones I know less about. I know there are certainly some that are basically, right, like don't actually operate a working lithium mine currently. I would probably try to stay away from those at this point. You know, I've seen these cycles a bunch of times with, God, I mean, I guess you could go back to the dot-com bubble. But more recently, we've had things like rare earth mining and fracking and pot stocks to some degree, where there was a big bubble in a lot of things, and there were a lot of, there were a few good companies that were actually doing business and growing, and then there were a lot of companies that had nothing really, were barely operating businesses that decided to declare that they were in those businesses or those lines of business, and they got a stock boost from it. I think, the last time cryptocurrencies were really hot, there was a company that made tea changed their name from Long Island Tea to Long Blockchain, and their stock got a huge boost from it. I absolutely would try to stay away from those things. At a certain point, if you find yourself looking through SEC filings and realizing that a company has changed its name several times in the last several years, that's probably the kind of thing to stay away from. I'd also look at the revenue line. If it's a company that is currently making money from mining lithium, that I would feel much better about than something else. But with the exception of the sort of like Albemarle, and I think there's another big established player that I can't think of right now. It is all a little bit speculative. So what is your thought on food commodities covered calls, such as the wheat ETF, given potential food shortages? I mean, that's kind of an interesting idea. I kind of like the idea of covered calls there as opposed to just a long position, because commodity markets are notorious for boom and bust cycles, although admittedly some of that stuff seems likely to stay tight for a while. And so something like a covered call would be a good way to make some money on the volatility there. I've certainly heard worse ideas. I probably want to look a little bit into how the wheat ETF works in terms of, typically most of those things buy futures or something like that. But it certainly seems like an idea that could work. And this is a case where I think the covered call on a thing that you're kind of bullish on might make more sense than just a long position, because of that volatility and the tendency of things like that to kind of bounce around some. Okay, Rick says, by historical standards, do you feel the market is still currently overvalued? It's getting pretty close. Like the S&P 500 is, I think, a P ratio somewhere around a 19 compared to historical valuation of around 15. And I mean, there's all kinds of, there's the Shiller PE, which is adjusted for some things. And but yeah, it's getting closer. I think by historical standards, if you just want to look at the numbers, it's still a little high. But really, I think if you look, again, there's still certain parts of the market that I think are still overvalued. And then there are other things that seem like they're probably bargains. So I think on average, things are probably getting back closer to normal. But I think in any market, there's always things that are probably overvalued and undervalued. But I think on average, we're getting back closer to a level where I don't feel like things are just nuts. All right, Donald asks, how are Chinese EV companies? That's the thing. I really don't know very much about the Chinese EV space. There are no Chinese automakers currently that sell in the U.S. anyway, and I think the Chinese auto export market is pretty small. which is not to say that they couldn't do well in the EV space. But I don't know. Given the opacity of both the Chinese economy generally and also those companies tend to not, the financial reporting from those companies tends to be less robust than their US counterparts, which I don't love. I also, I think we all saw what happened with Didi and some other Chinese companies over the last year in terms of the Chinese government kind of smacking those companies around. I have some questions about how willing the Chinese Communist Party is to let non-Chinese investors benefit from Chinese consumer spending, if that makes sense. I think they're certainly happy to take capital to build out, say, an electric vehicle industry. But once those companies can scale and achieve some profitability, how much capital will get returned to the US is, I think, an open question, and one that I have some concerns about, because I don't really understand why the Chinese government would consider the interests of US investors in terms of making decisions. Food stocks you can recommend. We've made some trades on the fertilizer space a little bit. Those have all pulled back a little bit. But yeah, I mean, like Procter & Gamble makes less food than it used to, but like Mondelez or Kraft or Coca-Cola, Pepsi are all, right? Like, I mean, those are all food stocks, but they're, Conagra is another one. Those are not necessarily, there aren't a ton of sort of pure play food stocks in the sense of like a corn company or a wheat company. You have Tyson, which is, they have some pork and beef exposure, but it's largely related to chickens. But yeah, I mean, anything can be a food stock or lots of things can be a food stock, right? I mean, John Deere can be a food stock if you think about it. But in terms of I think Richard's question earlier about wheat is maybe a better way to try to trade on a looming food shortage than trying to buy a stock, just because at a certain point you have to get the food off of a farm, and there aren't a lot of, outside of the animal space, there aren't a lot of companies that are public that are operating farms. And so if corn and wheat prices go sky high, a lot of the companies making food get squeezed because they're essentially buying those things as inputs. Will the Investor's Keyhole ever use bear call credit spreads? We do from time to time, and we get this question a lot. The issue really is that the Investor's Keyhole trades are picked based on news, insider trading activity, upgrades and downgrades, and unusual options activity. And insider activity tends to be more reliable as a bullish indicator than a bearish indicator. Insider selling is not necessarily bearish to the extent that insider buying frequently is a bullish sign. Unusual options activity, the put side of the chain just has more action than the call side, or the call side of the chain tends to have more action than the put side of the chain. Certainly the news and the upgrades and downgrades, we can do bearish spreads. But the other thing is that, right, like generally stocks tend to go up over time more than down. the reason you hear about people making a lot of money on a short trade is because a lot of people get killed on short trades. So we do just kind of have a bias in that regard that, and our performance over time has borne out that the bullish trades tend to do a little bit better than the bearish ones. So we do throw one in there occasionally, but it's not super often. Peter says, how do you trade in oil? Is there any recommended reading material? I mean, Peter, there's a bunch of ways to trade in oil. You can buy the stocks. There's ETFs that track the commodities prices. You can get into the futures or like options on the futures if you wanted. Personally, I try to stay away from a lot of commodities trading just because it's a whole different ballgame. And I don't feel like I have an edge that, I mean, you're, as a retail investor with a full-time job, I'm trading against people whose job is, buying and selling oil. And I don't feel like I bring any sort of edge to that environment. Rick asks, would you begin to build a position in the inversed fund cold given the significant rise in natural gas? So I'm not, off the top of my head, I'm not sure I know what cold is. Ultra short. All right, so these things, yeah. So the thing about these ETFs is they are dangerous. So this tries to do twice the performance of a natural gas price index on the inverse. So the thing about a levered inverse ETF is sometimes things have a big rally, and things can go up. If you think about counting, there's no limit to how high you can count, right? Other than, I guess, your time. Whereas there's a prices of things tend to stop going down at zero. So, you can see the problem there, right? A 25% increase in the price of natural gas would be a 50% decrease in your position here. If natural gas were to add 50% in a day, you'd lose 100% in a day. So especially when people say things like build a position, that makes me nervous because this is not a thing that you should put money into long term at all. I mean, you can look at the swings here. They're pretty massive in terms of this thing having been at a split adjusted $1,600 at some point, and now being 20. That's the other thing is all these ETFs buy futures and roll them, and there is a cost to that. And so, especially on the inverse side, they all tend to just go down over time, and then periodically they do a reverse split to bump the price back up. So I wouldn't just start buying something because the price of something else is going up. If you want to do this, this is great to take a long position on when you think the crash is coming. But the crash is coming eventually is not a reason to buy something like this. I mean, you may be better off on finding something that's like a 1x long, a 1x long natural gas tracker. I think UNG might be one of those. Yeah. So UNG just goes up with the price of natural gas. It tends to track the price, which we'll notice when we look at the chart here. Natural gas certainly went down a lot after the Great Recession and once fracking came online. but it started to go back up some more recently. Right, so what I was going to say is, if you really think this thing might go down, you might be better off looking at UNG and then trying to see how far out in time you can go and maybe buying some puts or something like that, as opposed to trying to do a, build some big position in a levered inverse fund. Peter, commodities rise with inflation, right? Generally, commodities rise with inflation. I mean, the definition of inflation is the cost of goods getting higher. Commodities are good, so they will tend to rise with inflation. Not all commodities necessarily go up together, but yeah, typically commodities rise with inflation. Some things might go up faster than inflation. I mean, you can look at this natural gas chart here. That's a big move in a relatively short time. Inflation is not 100% over the last 6 months. Right? So, and commodities do go up with inflation sort of as a general rule, but all commodities don't necessarily go up all the time at a level equal to inflation. All right, that I think is it on the questions. I don't think I missed anybody. Go back through, but yeah, if you have more questions, there's another 10 minutes or so left in the hour. If you don't, though, that is also okay. All right, well, yeah, to start wrapping up here, if you have a question, get it in now. But to start wrapping up, the session was recorded. We will post a link to that recording. It's just a YouTube video, as well as a copy of the slides that we went through today on the website sometime tomorrow morning, usually. And we'll send you an email when that goes up. The next workshop will be 3 weeks from today. That is June the 29th. If you have questions for the workshop, or you have a question you want answered in a more timely sort of venue, you can hit the help button on the website and send us an email that way. We get back to most of those pretty quickly. Yeah. All right, well, I don't see any more questions coming in, so I'm going to go ahead and sign off. Thank you all for coming. Thank you for subscribing to Investors Observer, and I will talk to you again soon.